Hello, everybody. I hope everyone's doing well today. In this video, I'm going to talk about something that is quite special when it comes to trading: compound interest. If you haven't heard of it before, you're in for a real treat because it is something that creates successful traders. It is something that allows traders to trade long term and make immense amounts of wealth while still protecting their business. What business? Their trading business. Because if you ask anyone that has been around for a long time in the trading industry, they'll tell you it's all about protecting your capital. Because wins can come, people can get lucky, but people also can get very unlucky. And this is a game of math. And if you don't understand the math, and if you don't understand how to protect your capital, or scale your capital, then you're in for a bad time. So I'll go through what is compound interest, why is it important, who should use it, and how exactly does it work. Okay, so what is compound interest? It is basically the interest on a loan or deposit calculated based on both the initial principal and the accumulated interest from previous periods. So you have your interest and you add on the initial principal, and the number you get from there, you calculate the interest again. So it keeps on compounding. I'll show you what it looks like on a chart pretty soon, um, after I go through these questions. But basically, it's something that allows you to exponentially increase your capital. Basically, if you were to plot it on a graph, it would look something like that. And on the bottom axis would be time, and on the, I guess you would call it, the x-axis would be, in dollar figures, your capital. And I'll show you some numbers in a little bit. But why is it important? Well, it has to do with risk management as well. Basically in trading, you do not want to be risking too much at one time. It's not a game of getting rich quick. Okay. You can get exponentially rich, but at the start, it may take some time. And that is the safest way to approach this, especially as a beginning trader or even intermediate trader. By risking small, for example, they have the 1% rule where you risk 1% of your balance or your account per trade. Eventually, the amount of money you start risking grows and grows through compound interest. Not only that, it has to do with psychology as well. If you're risking too much of your account, you're seeing it grow by too much in such a short span of time, even one trade, or you lose too much, even on one trade, it has a psychological effect. And if you lose a few consecutive trades and your account is down by 50%, that can do a lot of mental trauma, which is difficult to reverse as well, which is going to hinder your growth and progress as a trader. You do not want to create scars so early in the game. You do not even want to create scars. You want to harden your skin the right way. The last thing you want to do is rely on luck during trading. Okay, because anyone can get lucky. You may see a lot of influencers or people online making big bucks quickly. Either they are just blatantly lying to gain followers and sell courses, or they have gotten quite lucky. It is very rare for anyone to grow their account so quickly and consistently do it throughout their entire career. Some people win the lottery, but we do not go and buy a course on how to win the lottery because we know most of it has to do, or pretty much all of it has to do with luck, right? We do not sought after lucky people. We want to learn how to do it properly. We want to learn how to be consistent. and make money that way. Okay, so that's why it's important. Who should use it? I think everybody should use it. I mean, to me, it's the secret sauce, right? It is it is how you're going to make it as a trader and be able to do it um, consistently in the long run without fear, having confidence. So yeah, basically everyone should utilize compound interest, and not just utilize it, but um, keep it in their thoughts when they're trading. Because at the start, you know, trading has a lot of uncertainty, especially as a beginner. You're not sure if it's going to work. You take a string of losses, and the emotions start setting in. Your psychology starts getting affected, and you don't know if this is for you. And you don't know if you can make a living doing this. But if you keep in mind compounding, compound interest, and then you have basically something to look for if you keep on persevering. So, how does it work? I'm just going to pop up this calculator here. So, let's say you had a $10,000 account and you were risking 0.01%, which would be $100 per trade. Um, so, at $100 per trade, if you have an RR of 2, you risk 100 in an attempt to make 200 during a trade. So, as you know, as traders, it's all about percentages, and the more you risk, obviously, the more the reward. So, if you're risking 100 and your aim was to make 200 for a 2R, that would be a profit, and 100 would be a loss. But at the end of the day, it's only 1% of your account, so it's relatively safe, and you're not losing too much because of that. Because what happens if you have a $10,000 account and you say, hey, I'm going to risk $5,000 on this trade, and you lose? You're down by 5,000, which is half your account. You just risked 50%, and now you're 50% left. But what does it take to get back to 10,000? You need to make 5,000, which is 100% of your current account. So you basically doubled the difficulty in order just to get back to break even. And that's not what you want to do in trading. That's a losing battle. You do not want to put the odds against yourself. You want to put the odds um, with yourself, right? So that's why you don't want to lose too much of your account at one go. That's the whole point of risking small, and the whole point of relying on compound interest to grow your account. So if you made 200 on that trade, now you have 10,200, and we say that we're going to risk 1% again, 0.01. Now you're risking $102. So if you win a 2RR trade, you make extra $4 than you did before. Now this seems kind of slow, right? So let's have a look at a compound interest chart, just give you a better perspective and allow you to project yourself into the future and not be so focused on what can I make now, what can I make today on this one trade. So this is a compound interest graph chart that I created. You can set your original capital here. So for this example, we put $10,000 as your original account. Frequency is basically, you can call it whatever you want. You can say it's each day, each trade, um, each week. All right. So for example, let's just call this each month. All right. So if you made 1% for the month, you'd be up 10,100. On the second month, you make a percent again, 10,200. So at the end of 12 months, you've made 1,268, which is about 12 point, let's call it 12.7% in a year. Not not the greatest, but investors like Warren Buffett, I guess on average, they reach a return of 30% on their portfolios. But then again, they're dealing in millions. When you're dealing in small capitals, you have the opportunity to make more. But what if you made 3% per month on average? Okay, 1, 2, 3, 4, 5, 6, 7, 8, 9, 12. At the end of the year, you've made 42%. Now it's almost 3 times as much as the 1%, and 3% is about 3 times as much as the 1%. But now you just made 40%. And if you did that for another year, 24, you've made 6,000 plus dollars. So in the first year, you've made 3,000. You've made 4,200, and on the second year, you've made about 6,000. So you've made quite an increase. If you made 5,000, if you made 5% per month, and of 12 months, you'd be up 79% for about $8,000, and 2 years, 24, you'd be up $22,000. So you almost tripled your account in 2 years. We can keep on going. If you triple your account in 2 years, on the first year you've made, let's say you made 5%. All right, 5% a year. You've made 8,000 the first year. Second year, you've made significantly more. You've just made, let's do some calculations here, about 12, 14,000. 32 to 36. Third year, you've just jumped from 36 to, let me see, no, 32. Yeah. 1 second, I've gotten confused. 12, 24. Second year, 24,000. Third year, 43,000. Fourth year would be 48. 77,000, and it grows from there. So in 4 years, you've gone from a $10,000 account and you've grown it to $77,000. You can imagine if you do it for another year, it's going to be significantly more. And 5% a month is very doable on average. Some people make more. If you made 10%, you'd have quite a decent jump in the amount in the months, right? If you made 10% a month, first year you're jumping to an account balance of 31,000. Second year you're jumping to an account balance of 100,000, and first year, second year, and by the third year you have an account balance of 300,000. But at the time, okay, 10% is quite a lot. But if you're risking less, 5%, and if you're finding it too slow per month, even 10%, some people might find it slow. They're expecting to, make a salary out of it. If you, if you think long term, for the long game, 3 years, turning a $10,000 account into 300,000 is very, it's anybody will want that. If you ask anybody, hey, would you want to turn a $10,000 account to 300,000? They would say yes, definitely. But if they're looking at it month by month, they might think it's too slow, and they might start over leveraging and eventually blow their account because of the previous things I mentioned. 36 going to 48. Yeah, 300,000 to $1 million. So basically, even if you started with a $1,000 account and you doubled your account every year, by the 10th year you turn $1,000 into $1 million. See what I'm saying? So let's call this 100%. Let's call this a year. All right. First year you make 20,000, doubling your account. Second year, 40. Third, 80, 160, all the way to 10 years, you're at 10 million. This is a $10,000. I'm saying starting at $1,000, in 10 years, you can turn $1,000 into $1 million just by doubling it each year, doing 100% per year. say about 10%, 9% per month. All right, that's the power of compound interest. Trying to take a small amount and risk over leverage and risk too much, and trying to make a lot of a small account, trying to double your balance every single trade or even more. That's not going to work because it's the fastest way to lose your account. And once your account is down many percent, it becomes exponentially more difficult to climb. Not only that, you are psychologically triggered and affected, and you're most likely going to revenge trade, get emotional, and do something terrible. I want to show you a diagram now. This is called the plateau of latent potential, the valley of disappointment. You can find such a chart in the book Atomic Habits, which is a very good book on building habits. But basically, your capital P&L growth equity chart will look something like this orange line. And this is also basically signifies your progress as a trader as well. All right. So what people think should happen is this green line, just as linear growth, growing your account, becoming better and better as as a trader or whatever you do in life. It could be growing muscles, going to the gym. You think there's just constant growth, but there's always a plateau. There's always a plateau that you reach where it seems like you're almost going backwards or nothing's happening at all. And it's the same with the growth of your account. It starts slow, and eventually the amount of money you're making is just growing more and more and more and more and more. And soon it's just skyrocketing, and you're just holding on for your dear life, right? But you got to start down there and make your way up the slope and endure the valley of disappointment, just persevering and pushing on, not getting impatient, not feeling like you need to do more than what's already working. If you have something that's already working, my God, just keep on doing that. If you want to experiment with other things, have it separate from that, or be very careful with analyzing what you're doing and implementing new new ideas into it. If you have a strategy, if you want to implement something new, back test it first. Don't try in a live market and skew all your data and just affect your what you already have going on. All right, so yeah, that's basically compound interest, and I hope it's something you are considering uh, with your trading. This is the price. Keep your eyes on the price, and yeah, that's basically it. And yeah, till next time, I'll see you again.